So the next thing that the 2014 regulations did is they broadened the scope of 10.36. That requires that a practitioner with principal authority for overseeing a firm's federal tax practice take reasonable steps to ensure the firm has adequate procedures in place for purposes of Circular 230 compliance. So, if you're a solo practitioner who hires a couple people to help you in filing season, guess what? You're the principal person in authority for overseeing the firm's tax practice, and you are required to assure that those working for you are in compliance. Now, prior to the merger of my firm last September, my firm currently is known as Saul, Ewing, Arnstein, and Lair. I was the head of the tax practice of Arnstein and Lair, which was a practice of 150 lawyers with about 10 tax lawyers. And so the duty I had was to assure that those people working for Arnstein and Lair in the tax arena were adequately complying with Circular 230. A predecessor, a few years ago, I should say, I represented an accounting firm who came under investigation for this. The accounting firm had about 100 partners, and one of the partners was not an honorable person. One of his clients came to him for preparation of his tax return, and the accountant blessed an improper tax position that would resulted in a reduction of the taxpayer's income by $1 million or more. The IRS found that deficiency when they audited the taxpayer. They asserted penalties against the taxpayer. They asserted a preparer penalty against the partner in the firm who had not played well, who had engaged in bad conduct. And then after that, the firm received a letter that they were under investigation for violation of 10.36. That firm engaged me. Now, this was a quality accounting firm, a mid-sized accounting firm in Chicago. It had 100 members, professionals. About 35 of them were partners. They had others who were managers and others who were young accountants. The violation in this case had been made by a partner. Now, the IRS came in and looked at our procedures, and we showed that we had policies of training our people to do the right thing. We also had a policy that every time a tax return was prepared, somebody else in authority had to review that return before the send button was pushed on the computer. So if an associate prepared a return, a manager had to review that and assure quality before it went out. If a manager prepared a return, it was reviewed by a partner. If a partner prepared a return, another partner reviewed it. Well, we had a checklist that we could show for each return that went out of the firm. And guess what? We had one for the return in question, and it created this problem. And the dishonest partner had successfully hidden it. It had been reviewed by another partner, and the goal of the dishonest partner was to try to hide this from the IRS, but it also hid the position, the improper position, from his partners. And so, after a day of investigation, the IRS dropped the proceedings against that accounting firm. Had we not had a system of checks and balances, I think we'd have faced a lot more problems from the IRS. Now, remember, I said 10.35 was eliminated by the 2014 rules. But leave it to the IRS. Since they'd eliminated the covered opinion rule under 10.35, they didn't want to leave a blank rule under Circular 230. So guess what? The new rule under 10.35 is practitioners must exercise competence when they're engaged in tax practice. And it prohibits prohibitions on a practitioner endorsing, negotiating a check regarding a federal tax liability applies to payments made by any means. This was added because in the past there was a rule against negotiating checks, but some practitioners were arguing that they could have the client's electronic tax refund sent to them, or that they could have their fee from the taxpayer's refund sent directly to them by putting in a taxpayer's bank account for the majority of the tax refund and putting in the tax practitioner's bank account for the fee that was owed to the practitioner. And to make it clear that that was a violation of the law prohibiting cashing checks, the IRS added this rule. But let's go back to the first one, competence. Now, when this rule was first presented, I did a program, a webinar video presentation with Karen Hawkins, who was the director of OPR at that time. And she pointed out that competence can come in three manners. You can have competence, you can get competence, or you can hire competence. So let's go to a scenario that might occur in one of your small tax practices. You have a practice, you've been doing small business, mid-sized business returns for years. You are good at doing 1120s, 1120Ss, 1065s. But one day you get a call from a friend who says, here's an opportunity I have. I know a publicly traded company that recently dismissed their tax preparers. They're looking for somebody competent to do it. Would you like to be considered? And you said, well, what's involved? And they said, it's a pretty complex return, but I know the fee per year for preparing this return is $100,000. Now, you'd really like that extra $100,000 in your practice, but guess what? You've never done a larger company 1120. But now, what are your options? Well, you don't have the competence to just go ahead and take that return. But you could start a course of conduct, getting engaged to do next year's tax return for the company, where you sought out educational opportunities, attended continuing education classes on preparing the most complex 1120s. And if you completed that education, you would then be competent and could be in compliance with 10.35, because all of us have to learn new things all the time, and that's the reason we attend continuing education classes. But now, another way could be this. You know George, who just retired from a major corporation where he worked in the tax department, assisting the outside professionals in the preparation of 1120s. And George is recently retired. You call George up and say, I'd like to engage you to assist me in the preparation of a tax return for ABC Inc., a publicly traded company. Do you think you can do it? You check George's credentials. He clearly can. You work out a deal with George that he'll come in and assist you in preparing the 1120 for ABC Corporation. That along the way he will train you so that you can gain competence in doing that, and over time you can independently learn how to do this. Now, what did you do? You used the third option, hiring competence. So again, you can either have competence, which many of us have been in practice for years and have competence in a lot of arenas, but we're not competent in everything. You can gain competence, go out and seek education to gain that competence. Or 3, you can hire competence, which in the case of this practitioner, he hired George, who had competence in preparing tax returns. So let's move on. It used to be we put the disclaimer. We still have the if you believe that it's an electronic confidential or privileged transmission. If you believe it's been received in error, you should delete the message without copying it. But in addition to that, if you recall, and if you look at our written materials that accompany this, there was also the disclaimer saying that you could not use the transmission from you, the email or the mail, to avoid penalties. And on page 43, I have that old disclaimer that went on to every email that went out of my law firm, whether it was from a tax professional or others. So in that portion of the disclaimer on page 43 that says, pursuant to Internal Revenue guidance, be advised that any federal tax advice contained in this written or electronic communications, including attachments, or contained in this written or enclosures, is not intended or written to be used and cannot be used to avoid penalties. Well, with the 2014 regulations, as in the case of 10.35, elimination of the covered opinion rule, the IRS also took the step of eliminating the need for this disclaimer. It was put on there because of the tax shelter error, and it's now no longer required. Another change with the 2014 rules is the ability to suspend somebody first. And so, one thing I'd faced in the past is maybe my client hadn't filed tax returns for the last 4 or 5 years. He's a tax practitioner. And the IRS would write a letter to them saying, we're proposing to suspend you. But the person was not immediately suspended, and I could raise defenses like serious illness, a devastating situation that prevented preparing returns, be it a terminal illness of the taxpayer or their spouse, or some other major life event that caused them not to be able to prepare the returns, perhaps a major flood destroying a lot of records and requiring a lot of reconstruction. At least I could give excuses. With the passage in 2014 of this new 10.82, if you have not filed your personal tax returns or business tax returns in 4 of the last 5 years, the IRS will send you a letter saying, you are already suspended. We've done an expedited suspension. You can no longer practice before the IRS. You must petition for reinstatement and prove that there's good reason as to why you failed to file 4 out of 5 years returns. So in the past, you were given prior notice, you had the right to argue about it, you had the right to negotiate some resolution other than total suspension. But under the new rules, they can suspend first, notify later, and give you rights to contest it after you're in a suspended status. The same thing applies to quarterly returns. So if you do 5 out of 7 taxpayers that are not filed for your employment tax returns for your practice, you can face the same expedited suspension.